Hi, Warriors. Day before the Fed, some book squaring going on. How's everyone doing today?
Morning, Dale.
Hi, Mike. Hi, Ryan. How are you, buddy?
Yeah, not bad, mate. It's first day of spring over here, mate. I can't wait for the clocks to change. I get no time to do my hair between the flow show and this one.
Oh my gosh, yeah, we need a makeup person.
Yeah.
So, what do you make of this action in U.S. dollar yen? Kind of cut under this wedge, like a little bit of a throwover. Now we're back inside of it.
Yeah.
What do you think? Are we putting in a low?
We could be. I like the way it stepped up the low. So we had that 130.50, then it stepped up to 131. If you compare it to the last few days, we had that low where your trend line starts, then it made a newer low, then it made a newer low. You know, you need to wait for the turn, if you like, when you stop making new lows and you start to make higher lows. Not going to, it's one higher low, so I'm not going to say it's a definite bottom, but that's how things can start, just from simple price action like that. And we'll see what happens. I don't know what's going on. I don't know if why risk is suddenly all better, maybe because we haven't had a bank go pop for a few hours. Maybe it's a bit of squaring ahead of the Fed. Who knows? Sometimes no news is good news, eh?
Any reason why Euro is outperforming cable today, which hasn't done in a while?
Yeah, again, it's a bit of a head scratcher. We've thrown a few themes potentially at it. Maybe, as Kay mentioned on the Flow Show, China, Xi, Putin meeting May. Maybe the market's getting hopes up for some peace in Ukraine. Again, maybe just a bit of risk on across the board. We're seeing commodity currencies down, which is strange. Look at the Kiwi. Because you look at the commodities and you think, well, from that basis, you shouldn't be seeing Aussie and Kiwi and other commodities down, but they are. So yeah, bit of a head scratcher all round at the moment.
Yeah, really, they turned out to be the weakness on this decline in the dollar, and I'm thinking this decline in the dollar is going to stop between here and 102, and the yen turning first. That's the one you probably go with if you want to be long the dollar. If the dollar keeps going down, I'd buy the relative strength. Yesterday, you couldn't tell because they both looked negative, but the reaction in yen compared to the dollar, I think that's the U.S. dollar pair I'd go to. And I think that there's a buy in here. I don't think we're going straight to new lows under par 50. Right here.
Yeah.
My bet is that it holds in here and that we get another one of these from wherever it digs its heels in. Just, what I'm thinking. Gold silver ratio's turning a little bit, where gold is a little weaker now than silver. But silver, something I'm looking at on a shorter term time frame, is well, I'll even go shorter. How about this? What do you see here?
I have to bring Stel or Kane for that one.
Well, RSI divergence, right?
Yeah, a lot of that, and something that I've shared here on Face before, and when I teach 3 drives, if you call this 1, that's when we were confirming, and this one was still over 70, and then we blew out the divergence and made a new high. It looks like a 3 for the third is setting up here. So, a rally over these highs on the Fed. I may take a shot at the short side of silver. I know this crude. Go ahead.
I was just going to say, sorry, if it wasn't for the Fed tomorrow, this makes a lot of sense, but the Fed can, it's a binary event. If they pause, then I think it's all resolving to the upside. If they don't, if they hike 25 and they remain relatively, on the hawkish side, or rather not on the dovish side, then this is going to be going back towards 2150, I think 2160.
Yeah, good. And there are signs now in WTI that we're getting close. It may have bottomed yesterday, but this one is even clearer. If we get one more shot down, look at the divergence here at this low. It's glaring, held over 30. I don't know. This is 1, 2, 3, 4. Basically, this is one drive because this low never took it out. This was the second, and the RSI was here, and the third, it's still held above 30. So, potential bottom. Could get one more shot down, but I don't think I'd be short the energy complex anymore. A long time ago when, we were in the 80s, a lot of targets were 62. Well, I don't know, 64 is close enough for government work. Maybe we'll get it 62 for a third, but then I think you back up your tanker. So,
yeah.
That's what I see there. What's Dr. Copper doing? I tell you, this copper looks bullish, looks bearish, looks bullish, looks bearish, looks bearish, looks bullish. But, what's her name? Tracy.
Did you say, yes. What's her name?
I did, yeah.
You did. Sorry.
Sorry.
Whatchamacallit.
Yeah, it came to me, I remember, but now with the lag, calling this a bull flag, Tracy called it. What's her name called this a bull flag? And it kind of looks like it. What's his face? KMan. I wonder what he's doing.
Sorry, I was just doing my hair, Dale. Good morning.
You're getting ready for the showtime.
Oh, he's got a company hairbrush, is he?
Yeah, so don't pass it around. You get dandruff that way. So, KMan, your thoughts on what's happening here in yen? Think we bottomed here?
Well, first of all, it's the Euro show this morning, right?
Okay.
There's a couple of plausible reasons why it's shooting higher. Is that probably the market was short due to the Swiss proximity and has to buy back the Euro shorts. But there's something going on this on the European yields. German 10-year yield has jumped 33 BPs in 24 hours time. That's a huge move. I think the Xi Putin thing, we haven't heard much about the actual plan, but perhaps the market also wants to view it as a little bit positive, as I said on the flow show, but we still haven't heard about anything, so we can't really bank on that. But the moves that I saw today are like, it reminds me of some very strong hands when they were playing when they were trying to buy Euro crosses or so. They come in and then they sell the less liquid first, and then they make it look like a dollar move, and then all of a sudden they're buying Euro dollar and to get into the crosses, and the crosses really ramped higher this morning. You can just look across everything. Barring Euro Swiss is very stable, but the rest Euro yen, I think it's more Euro yen than dollar yen, really, what is going on. So there's a lot of positivity in this euro this morning, and I wouldn't really just try to explain it by this is pre-FOMC or just short covering. It looks a little bit deeper than that to me. As for the yen itself,
maybe it's a call on the Fed. That
Sorry?
The ECB, maybe it's a call on the Fed.
Well,
the ECB was, went hawkish with the half, and the market thinking the Fed at the most is going to do a quarter, giving the interest rate differential edge to euro. Could that be it?
Yeah, that is
that's all
possible.
Dumb stuff.
The euro differential versus everything, basically.
Okay.
Yeah, that's possible. But also yesterday in the news about those 81 bonds and stuff, it seems that the eurozone is qualifying them a little bit better than equities, shareholder equity. That may be, but then that came out yesterday already, and yesterday euro didn't rally. So I think this morning is something different though. I think it's really somebody who's really buying a lot of euros here. And then as for the yen is concerned, yeah, I think it's more euro yen, but yeah, the dollar yen, this 130.5 is a pretty decent area where we held again. It goes back to 2021, and yesterday we tagged it. It bounced again, so that has to do with it as well. I reckon.
Look at how the green 50-day moving average acts like a trend line.
Yeah.
And if you take the bottom trend line, you have a falling wedge. Okay, so we're on the verge of breaking out this falling wedge.
Yeah, and the daily cloud, the top comes in at 132.70 today, so that's going to be another level to keep an eye on, which is not far from where we are.
So if you believe in wedges, KMan, you're a technician. How much can wedges retrace? Yeah.
Me, a technician?
Yeah, you're a technical analyst.
Yeah, but I mean, technically, yes, technically is a lot less my thing, but
all right.
Yeah, why not? Why not go up there? I wouldn't rule it out. My long-term view on the yen hasn't changed. I know a lot of people are looking for it to go a lot lower, but give it a lot lower and I'll know what to do. Give me a move lower well, down into the 127s or 128s, and I think I'm going to buy it and close my eyes.
That's being led by yields here too. Same formation, a little bit of an overthrow.
Trade, right?
Huh?
It's still one big trade if you look at yield and everything. It's still one big trade, yields, risk, you name it.
I thought we'd go to 370, 380, and then maybe we have another swoosh. If we have another swoosh, I have to think it'll be this bounce in the S&Ps terminating at 41, 42.
Has to be said that Powell has always managed so far to walk an ever thinner line. Tomorrow maybe a biggie for the FOMC, and the dollar to take really a direction there.
Yeah, how do you spin a liquidity crisis with tightening?
QT, change QT for a bit, saying that they have already done it because half of their QT so far has been wiped out with the liquidity injections. That could be the kicker tomorrow. I think anything about liquidity. I don't think that, well, they shouldn't. My base call is that they go 25 and then we see what they say around it.
I heard someone say the liquidity crisis, is over. The credit crisis is just beginning.
Yeah, I mean, that's people remembering what happened in 1998, 2002, and then saying now we are going to go into 2008.
Yeah.
Right?
Right. So the banks, because of the hits and deposits leaving, tightened credit standards. And especially the small banks were more involved with local business, local communities. That's going to have a dampening effect on the economy.
It has, but at the same time, it's also deflationary in a way. If you could explain it like that, but
yeah, that's what Powell wants. There are a lot of people that are bearish commodities for that reason.
But the situation is so fluid still right now. I mean, we've never seen those bond moves as fast as we see them right now. And I don't mean by we have never seen those kind of amplitude moves. It's just the way that they jump up and down. That is new to anyone in the market.
Yeah. That chart does not look bearish to me.
No,
okay, so let's see here. Steve, how are you, buddy?
They are even going faster.
I'm good, Dale. How have you been?
Okay, feeling good?
Yeah,
Okay, that's not a convincing, yeah.
You'll
I
have
can
to live
read.
with that, though.
I can, I can tell, man. Anyway, so thoughts on what's going on into the Fed?
First of all, I'm going to start with saying that I agree with what KMan said. I also think that the more likely scenario is that we're going to see a 25. I think if they've assessed the situation, probably they will have probably realized that if they completely halt, they
They'll
might
panic.
send, yes, they might send a message of panic. Yes, correct.
Yeah.
So
Yeah.
I do think that the chances of a 50 have practically gone out of the window. You never know, but I think the chances are, super low if existent at all.
Do you want to buy the dollar on this dip, Steve, or do you think that we completed it and we're headed towards new lows? What's your bias here? On, from we had about 500-point move from here to here. Is this a dip to buy, or are we just going to wash out here?
I think we're getting very close to finding out what the case is.
Okay.
Today, we seem to be confirming a breakout higher in the Euro USD. The USD yen has reversed from an interesting area. The DXY is testing important support. The S&P is approaching key resistance, above which it's going to break out to the upside. Crude is
You talking
reversing.
about this trend line here? As far as breaking out
Yes,
to the upside?
yes, the one that you're about to draw. Yeah.
Okay, this little trend line here. Okay, got it.
Yeah.
Okay.
So there is a channel in essence. The whole
Right.
move lower is has been ordered. The last move lower has been orderly and channeled.
Yeah.
Okay. So I wouldn't necessarily be looking to buy the dollar here. No.
Okay.
Of course, the Fed is very important, right? Now, in general, no matter what happens, even if we see a big rebound in the another rebound in the dollar, as I've said before, I don't think the dollar is going to reclaim its high from last year.
Oh, no.
So in my opinion, the dollar rebound is corrective. Now, if that correction higher is over or not, we're going to soon find out. But nevertheless, I don't think we're going to be seeing the, what was it, like 114 high in the DXY. No, I think the chances of seeing that level print again are tiny.
Yeah, very low. Yeah.
Yeah.
But we could get like equality here, maybe up 107, 108. This was a big area.
The thing is that we already saw equality at 105.73. If you look at shorter term,
this was what, 38% correction, weak. Right?
We almost reached the 38.2, but we reached the quality target from the first impulsive move higher, those 3 strong days after we began the rebound. Then we had this little correction that you see over there. And then equality target to that was at 105.73, which is more or less where this rally stopped, right? Yeah. So I think there is a very good chance that the dollar is already on its way lower. Not 100% sure, but I think there is a very good chance.
Anyone have an explanation for weakness in Aussie comparatively? I mean, it's not risk off.
Can we ask the viewers, because we got no clue?
Yeah. Any of the attendees have an idea? Go ahead. We have chat working here. Okay. You, Blake?
Hey, good morning.
Morning.
Can we just say that really the only thing that's moving today is really the euro? I mean, the euro's the euro and I guess the yen's recovered because of yields, but really this is like a euro move. I mean, you look at the sterling, it really hasn't moved much. The Aussie hasn't, and neither is the Kiwi. And even the dollar CAD, had a CPI today. It's not really moving either. It's just the euro and all these crosses. I mean, you're just seeing the euro just rally against everything. And you know, I listened to what KMan said, and I kind of agree. I don't think it's you know, I think it'd be kind of lazy to say, well, it's, you know, the euro's, you know, rallying, you know, as position squaring ahead of the Fed. I you know, when you look at all the crosses, it looks like it is this is a Euro-centric move this morning. I mean, obviously you can look at Norway and, you know, say, well, that's just the inverse of that. But you know, I think it's just a euro move and yields, because you had the euro yen really pivot off a really very important support overnight. I mean, it hit a daily trend line that has been so significant to the pair literally for, you know, the last, I would say, you know, year, that we bounced off of it so aggressively that and we had a hammer yesterday. It just, you know, like a lot of follow through. So I don't know. I think the dollar, the rest of the dollar complex is really waiting for tomorrow. But I want to ask you guys, and by the way, I should probably take the euro yen and just show you guys what the euro yen looks like. This is really, oops, let me remove that. This is really key support. You can see the daily trend line from August of last year. We, you know, probed it yesterday, and then we bounced pretty aggressively today. But I should probably ask you guys this, because I ran a poll yesterday on Twitter, which has gotten, oh, I don't know. Well, hold on, let's see. We can go to profile. Let's go over to, it's been 3,000 votes here, 3,700 votes. You can see there's a, you know, raise a 0.5%, as Steve said. That's probably not realistic. Then there's a quarter, then there's no change, and most people obviously fall in that category. I've had some rumblings of people saying, well, why isn't there a cut on this poll? Why didn't you know, add a cut? And it's like, because I think that would be the Fed sending a completely wrong panic message.
Yeah, theoretically speaking, there is a probability, but I think it's going to be catastrophic, and they know.
Well, there's always a probability for anything, right?
Yeah. No, I mean,
so,
think about it. A lot of people are calling for a cut. I just saw, it was funny. I saw Elon Musk calling for a 50 basis points cut yesterday. I don't know if you saw
Musk?
it. Yeah, I'm not joking about it.
Yeah. I mean, look, I mean, theoretically, could the Fed cut? Yeah, but we all know that the Fed's mandate is inflation and price stability as well, right? But inflation is obviously still not under control. So for them to just light the fire underneath the inflationary pressures again with rate cuts going from, you know, raising 50 to cutting, that's just very unrealistic in my opinion. I think more realistic is the Fed actually just continues to march on like the ECB. Now, I don't think that's going to be the case, but I think that is still a possibility. And even for them to actually not and just take a pause, which I think is an increasingly popular opinion, is not an opinion that I share. You know, I think the Fed would probably send the wrong message that they've actually broke something. So I don't know. But I think this is realistic. But I guess what I wanted to point out, and the reason why I want to point out this poll that you guys see on my screen, is that raising 50 is going to be the least expected, and it's probably going to elicit the biggest move. So that just something to keep in mind as we go into tomorrow. But anyway, we got a few minutes, and I want to talk a little bit about the Canadian pairs, because we do have inflation data that's coming out today, and we have Canadian inflation data. Did you guys talk about that on the Flow Show? I caught the last 15 minutes, Ryan, but did you talk about Canadian data?
Yeah, we talked about it in the last 15 minutes of the Flow Show.
Well, okay, then I must have been walking away to grab my coffee, because I do that at the 3 o'clock in the morning hour. What were you guys talking about it, and what did you guys discuss?
Well, obviously talking about the loonie, it's sitting on quite a important support level, 36.50. There's been an on-off S&R area. You know, trade it the same way as everything else. If inflation falls, then that keeps the BOC on pause. If it comes in hotter than expected or up on last month, it's going to turn expectations for the BOC are a bit more hawkish, and you're likely to see the CAD gain, particularly if oil picks up a bit further. It looks like it's dead cat bouncing in oil at the moment. And yeah, you know, got another level 135.5, and then a big decent level 135. You've got the 155 moving averages on the daily down there, and it's another support and resistance area.
Yeah, I think the 136.50 is like, if I had to guess a line in the sand in the market, that's it. Because, you know, staying above 136.50, so let's say inflation does come in line, maybe even slightly worse than expected, that might free up the dollar CAD to move higher. And that has been a trend, right? A trend is the trend that we're seeing in inflation globally, and you guys correct me if I'm wrong, especially in like some of the European countries, is inflation has seemed like it's peaked. I wouldn't say it's really coming down, but you're starting to see pressures like wane a little bit. And so if that's
back up in some.
What's that?
It's going back up in some, France,
in some like pockets,
yeah.
right? But let's say, you know, here in the US and in North America, you know, inflationary pressures seem like they're stabilizing, if not, you know, coming down slightly. So if that's the case, maybe it gives the dollar CAD that freedom to push up a little bit. But, you know, if we do break below 136.50 and we start, you know, trading, you know, towards 135, I think that removes the picture of a possible butterfly pattern that was developing here. We have a Gartley, and that's a more of a, you know, long-term, you know, top that we're forming in the dollar CAD. So I think it's worth noting today. I want to take a look at some of the other Canadian pairs, because one of the other things that, you know, I'm obviously really closely watching, because I do have yen exposure, is, you know, you got the Canadian yen also on very critical support. You can see it bounced off key support, just like the euro yen did. Kiwi yen, horizontal support. Aussie yen, horizontal support. Sterling yen, you know, ascending wedge or ascending trend line support, just like the euro yen. So the Canadian yen, same thing, right? We hit off of this support, which means to me this 94.50 or, you know, close to yesterday's lows are going to be very, very important. But, you know, weaker inflation data could put that under pressure. Now I know at least KMan recently, has anybody been watching the Euro CAD and the pound CAD?
Yeah, I've been watching it, but I haven't had anything in it.
Okay, yeah, me neither. I, you know, kind of keeping it on the radar, but not doing anything either. But you can see they're actually approaching some trend highs. I mean, look, you look at the Euro CAD, you know, some weaker Canadian data today would put that in probably new high territory, I would assume.
Yeah, so put a line from that, what is it, December high, just where, yeah, that little one looks a bit breaky, no? The prior high, the one which is early Jan or so, you know, you take that one into account, then we are like in breakout territory, right?
Yeah, I mean we're close, so
it's dangerous,
yeah.
right?
Yeah, it looks like the Canadian could continue to weaken. I think, you know, one of the things we can look at real quick. Let's take a look at the Canadian dollar futures. And, you know, I mean, you can see this is a pretty big, you know, I mean, it's overall pretty weak, but look at and this is a weekly chart, by the way. You can see if the Canadian currency really comes under pressure, it could really break down on a weekly basis. You know, that's more of a long term. You know, I guess we're so close to data. So let's go ahead and get on a 15-minute chart. Let me pull up the oh shoot, I don't know why I deleted it, but let's go ahead and pull up the data flash. And let's see that data as it comes out. How much time do we have, Stel? Where you been? I got 30 seconds.
30 seconds. I'm here listening to you talk about
blah blah blah
nice
blah
things.
blah. I know, you know, it's interesting. You know, before the flow show, I mean, the flow show ends, and then, you know, this face show picks up 45 minutes later, which gives you guys a very tight window.
Yeah.
Yeah, you're all talked out from the
They're all
flow,
talked
man.
out. You can tell Stelios sounds like he's tired, like he wants to go back to sleep.
I am tired. It's okay though.
Softer 5.2 year on year. Bank of Canada core 4.7, lower than 4.8 expected. So all down, down.
Red.
Yeah.
Marginally, but down.
Yeah, year over year, still kind of strong, but you can see the monthly data starting to show it. So, yeah, we had the little bit weaker Canadian currency and trade has what a BS is that butterfly pattern. A butterfly is a harmonic pattern. It's a pattern that develops after a Gartley is developed. So if you look at like let's just say it's a Gartley pattern looks like this. Okay, when you start breaking out in extensions, they turn into butterfly patterns, which look like that, something like that. Anyway, I know we have a very good interview coming up. I'm excited to listen to Mr. Perkins. But before I do that, and I turn it over to Dale, I have to mention, if you guys haven't checked out ForexAnalytix, make sure you do so. We have probably one of the most busy trading communities around. Like this is, you can see I've been up for about an hour, and remember, the whole team was on the Flow show this morning. So you can see this is just in the very basic chat room. You guys are on Jumbotron, by the way, if you guys are listening in right now. But that's just the general chat room. Then we have a Flowonomics room, which is the macro chat room. We got news and research. We have the actual trades room where we place our trades, like somebody might have figured out. I just went long the dollar MEX this morning for a bounce, and the S&P room, so we got a lot of chat rooms going around and in here. So make sure you check out forexanalytix.com. Dale, it's all yours.
All right, Blake, team, thanks very much. I know,
thanks, guys.
The day before the Fed, hard to put a lot of conviction out in front of a major red event. So we have a red event. What a great guy to have with us to talk about what's been happening on the financial scene. Dario, welcome back to F.A.C.E. How are you?
Hi there. Yeah, not bad. It's certainly exciting times, so that's something.
Yeah, may you live in interesting times, as the Chinese say, right? So what's top of mind? I know there are a lot of things to talk about. What are you mainly concerned about? Is this liquidity crisis with the banks going to drag on for quite some time, or are we close to buttoning it up, which I doubt?
I think that's difficult to say. I mean, at the moment, my focus is very much on central banks and whether they're losing control, because we came into this year and they had this very clear sort of mantra. They were going to keep monetary policy quite tight. It was all about higher for longer. And they wanted to have this sort of controlled, gentle disinflation. Yeah. These central bankers, they're all control freaks. They believe they can sort of finely tune the world. And then they've been sort of run over by what's happening with the banks and with this very aggressive tightening in financial conditions. And I think at the moment, it's really difficult for them, because I don't think they have a true sense of how tight monetary policy is right now. They can see what's happening with the banks in the US. They can see that these banks are probably tightening credit conditions quite quickly. That could have, quite a big effect on small and medium-sized companies that are much more sensitive to bank lending. And so you've created this sort of big extra monetary squeeze that these central bankers weren't expecting. And they really need to get control of that now, because otherwise they're not going to have any sense of, they're still going to get the disinflation, because obviously if you have a serious sort of banking crisis, you get disinflation, but you lose control of that process. And so I think, right now these central banks are sort of caught between this horrible dilemma, because on one side, they've been totally fixated on this sort of ghost of the 1970s. They're very aware of the mistakes that policymakers made in the 1970s when the economy seemed to be slowing, and then they would ease policy quite quickly, and then the inflation would linger and then come back as the economy recovered.
You know what, Dario? Maybe in the 70s, guys that were running a book for a bank used a chart and didn't stay wrong for a year when the Fed is clearly telegraphing what they were going to do, and pull a Nick Leeson with their banks.
I mean, that's true.
I think that's a sickening part of it is, go ahead.
I mean, you can't really have any sympathy for what's been happening. I mean, the bank should have seen this coming for a while. But I think if you're a central bank
and we all suffer from mismanagement. The only thing that anyone could ever control in this business is risk. And they did nothing, and then they get bailed out for being negligent.
But I think the other side of this dilemma is that central banks themselves have this sort of post-traumatic stress disorder from 2008. And they think that the slightest sort of problem in banks will quickly sort of get amplified, and they'll get this reflexivity, and then it'll all kick in, and they'll be back facing, what happened in 2008, which in this environment is sort of ridiculous. Yeah, but that's the dilemma that they have. It's sort of post-traumatic stress disorder versus 1970s ghosts.
Well, they've given me post-traumatic stress.
Well, yeah, I mean, I was sitting on the RBS trading floor as 2008 sort of erupted, so I have a bit of that too. Yeah, and I think that at the moment the sort of the stress disorder is winning out, because they're clearly doing everything they can to try and get a handle of financial conditions again, even if that means going too far. Even if that means doing some kind of QE and calling it something different, even if that means bailing out banks in the extreme, even if that means cutting interest rates. I think that they're very much fixated on preventing those sort of dynamics from happening again.
What's scary? These are the blue chip banks. All right. These are not your mid-sized banks, community banks. These are the blue chips. Pretty ugly chart. This is where people are transferring their money to. I mean, how much more comfortable should we be with these?
Not exactly. I think in the end, all of these banks will be bailed out, and we're not going to get that sort of dynamic kicking in. But at the moment, this is very much what central bankers are focused on, trying to control this process. And even if that means sort of taking their eye off of inflation for a bit, I think that's where they come down on this. I think that, the template is probably the Bank of England, because, the Bank of England sort of went through this. I mean, it was a bit different because it was about pension funds, but they had the same issue.
Well, that's next year.
Well, they had this dilemma.
Who didn't own bonds when we were at rates that we haven't seen since the Civil War? I mean, they all own bad paper. They're all down on their paper. Pension funds, communities, municipalities.
It's the whole financial sector is sort of being caught out by this idea that interest rates were going to be at zero forever, that central banks sort of perpetuated, and then it's all sort of unraveling. And so
what do you think happens now, Dario?
Well, I think what they want to do is get a handle on this. I think they will. I think even if that means sort of bailouts and asset purchases or whatever, I think that's very much their focus. And so, I don't think this is going to sort of lead to some, much deeper financial crisis. I don't think this is going to cause a sort of gut-wrenching recession. I think we're still a long way from sort of big job cuts, particularly in the US. There is still massive demand for labor. The demand for labor has basically gone up for 3 years now, and the supply of labor has gone down. So you've got this massive excess demand for labor, which you could take out just through job vacancies. So, you could destroy a lot of demand without actually causing companies to start laying off people and to get a sort of classic recessionary dynamic. I think we're still some way from that. But I think that what this is going to force on these central banks is gradualism, because, that's exactly what happened at the Bank of England. The Bank of England was very, very hawkish, very, very aggressive. Something started to blow up in the financial sector. It dealt with that problem quite quickly. It used a sort of version of QE to do that. And then it kept interest rates higher and it kept hiking, but the extreme hawkishness that it had before had gone. And suddenly it was all about sort of very gradual tightening, talking down market expectations for the terminal interest rate. So I think that's where we go. I think, that sort of extreme chasing inflation, raising interest rates aggressively. I think that's gone now. And I guess, you know, I've always been in the sort of secular reflation, not sort of 1970s style reflation or inflation, but gradual. You know, I don't think we're going back to 2% inflation. And I think the way that central banks are dealing with what they're seeing right now sort of confirms that, you know, that sort of 3-4% inflation is probably the floor now rather than the ceiling, which is what it was before. You know, they were always trying to get inflation up to 2. Well, now I think they're always going to have a very different type of battle, which is that inflation always threatens to break too high.
Okay. Well, then from what you're saying, will the market be able to make new highs in the 10-year yield, even if we still work lower towards 3.20 or even 3%? Do you think this is going to be some type of high at 408 that we're not going to see for years? What could take us back there if the Fed is done?
For sort of 18 months. But I think that this is a sort of secular bear market in bonds. I think that we're seeing these massive swings in yields, which are all about sort of recession risk and sort of inflation worries. And the pendulum is switching very quickly from one to the other. And we've got this massive sort of distorted economy. Central banks have amplified the volatility of their economy because they really freaked out about inflation. They raised interest rates very, very aggressively. You know, we're at the point now where they seem to have overdone it and are now sort of switching back the other way. So you're sort of retracing some of that bear market in bonds, but I don't think we're going back to sort of previous lows. And I think what we're going to have, you know, for the next sort of number of years is higher lows and higher highs over time. But it's a very volatile economy. And, you know, if central banks pivot too hard, then they'll quickly have to pivot back the other direction. So we've got this sort of policy-induced volatility on top of what was already an extremely distorted and sort of noisy economy because of all the distortions from pandemics and wars and all of the other stuff.
Okay. So, you know, geo stuff is not your wheelhouse, is it, Dario?
No.
Okay. I'm going to ask you about it anyway, because I know you pay attention to it. You have to. So, I mean, the whole world is focused upon whether or not the Fed will pause instead of being focused on Russia and China are not pausing. Do you think we're gonna have some blowback from what seems to be recent developments in that war, that you know, people have to be concerned about the fact that we could be escalating? No one's really talking geo much anymore.
Well, yeah, I mean, I don't think that most investors are really thinking about what has changed over the last few years. So they're very much focused on sort of very short-term economic cycles, very short-term policy cycles. Okay. You know, we know that when the Fed pauses, typically, you know, equities jump sort of 20% quite quickly. And so that's been the complete, you know, focus of everybody. And I think that, you know, when you look through all of the big noise and distortions of the last 3 years, because, you know, I've said before that I think this whole cycle has been a sort of head fake. You know, it was never a sort of normal organic business cycle. It was all about, you know, government manipulation and intervention and central banks sort of pivoting one way and then the other.
Did you watch that Frontline special? Did you watch that Frontline special?
No.
On PBS, they have one on, you know, basically the Fed. Very good. I was surprised they didn't have you in there asking you about this too, but
I'll check it out.
But
I think that when you look through all of these sort of, you know, this fake sort of business cycle and all of these distortions, there is some stuff that's changed. You know, supply chains. We're never going back to the supply chains we had before. You know, we have clients at some of the big shipping companies. They tell us that they're having these sort of wild conversations about how, you know, trade is going to get rerouted in a way that they'd never had before. And then geopolitics is the other one. You know, we now effectively have this Cold War between, you know, US and China. We have a hot war in Europe. And, you know, that's going to change the structure of the economy. You know, big defense spending is now here to stay. rapid energy transition in Europe as it tries to get away from Russian energy. Protectionism, sort of strategic intervention in commodity markets, semiconductors. It's a different world. If you think about the last sort of 40 years, it was all about neoliberalism. It was all about sort of trying to minimize the role of the state. It was all about free markets, or supposed to be about free markets. It was all about central banks sort of finely tuning the economy and fiscal policy not really playing a big role, or that was beginning to change over time.
We're headed to the opposite polarity now.
This is and this is part of the long super cycles. You've had three long super cycles. You had one from sort of 1870s to Second World War, and then you had the Second World War to the 1970s, and then you had the early 1980s to 2019. Those are the big super cycles for inflation and interest rates. They're all dependent on politics, on the sort of balance of power in the economy, the balance between labor and capital. Sort of 19th century was all about capital, globalization and, small governments and capital was completely dominant. And then after the Second World War, we had this big political shift towards labor. So we had trade unions, we had protectionism, we had the welfare state, we had all of that stuff. And that led to the stagflation of the 70s. And then from the early 80s onwards, we did everything we could to try and ensure that the 1970s would never come back. And that was neoliberalism. And, the basic sort of tenets of neoliberalism have gone, because we're emerging from this crisis in a very different world. And when you look back at these sort of big super cycles, it's always something like a war or a pandemic or, some kind of big global historic crisis.
Shock.
That's always the thing that marks it. And I think, we're so fixated on these short-term policy cycles and, very short-term moves in yields that we're missing this bigger picture. And that, I think, is going to be the theme for the next sort of 5-10 years.
Do you think that there are going to be bail-ins as this banking crisis unfolds? Or are they going to bail out are they going to try that? It seems like they're trying everything, like like in the Credit Suisse example. Normally bondholders get bailed out.
I think that they're quite scared of doing those. If you look back at the Euro crisis, when they tried to bail in investors, it led to these sort of amplified issues and problems.
Well, I
just think that they're going to backstop the entire system. They're going to say that the sort of universal deposit insurance, I think, is coming probably quite soon.
So is that one step closer?
I'm surprised they haven't done it.
Is this one step? Yeah, they may. Is that one step closer to the biggest monetary story since Bretton Woods of the CBDCs? Is that part of it?
Well, I think, you need to think about what is the problem with the banks. So, for the last sort of 12 months, we've all been looking at the financial sector, wondering what was going to break. And weirdly, nobody was really looking at the banks because, the banks were the cause last time. And we thought that regulation had sort of dealt with that problem. And when, the problem started in Silicon Valley, I mean, that seems we should have seen that coming because, these banks, they had massive exposure to zero interest rates. They had these big depositors that were all tech companies. They were massively exposed to interest rates going up. Then they'd been buying sort of MBS and government security. So that made them sort of doubly exposed to interest rates going up. And then, as those problems in small banks have sort of escalated, then people have taken money out of the small banks and put them into the bigger banks. And that sort of escalated the problem. But ultimately, as you said at the start, this is about duration risk. It's about investors getting caught out. And when you look at banking in general, clearly there are those exposures there. A lot of these banks have been buying bonds. But also the other part of this is that all of these banks have been writing fixed rate mortgages. And policymakers have looked at that and they've said, well, these fixed rate mortgages are really good because it means that interest rates going up isn't going to squeeze households. Right. Well, sure, but somebody's getting squeezed and it's the banks. So the only way the banks can deal with these problems, the losses they're making on their bonds and the losses that they get from having written all these fixed rate mortgages as interest rates go up is they have to screw their depositors. You know, they have to keep deposit rates very, very low. And that's becoming increasingly difficult because there's somewhere else you can put your money now. You can put it into US treasuries, you can put it into, lots of other different higher yielding assets. And so, the banks are getting squeezed because of this dynamic. I mean, that's a dynamic that isn't going to go away.
I thought the banks really didn't hold mortgages anymore the way they did in 08, that, they would do the loan, but they just farmed it out into some product. They didn't keep the mortgage on their books. Am I wrong?
With the banks that we're talking about, which are the sort of small and medium-sized ones, I mean, most of their assets are some form of mortgage. They've been massively involved in commercial real estate. So that's the other sort of structural problem for these banks, is that the commercial real estate sector is now getting killed. If you look at vacancy rates in offices, they're going up for really obvious reasons. Nobody's going to the office.
Yeah, you're not in an office right now, are you?
No, I'm at home. So you have this.
We all are.
I tried to avoid the office. So you have this. You have this at the moment. You have this liquidity problem, which they can deal with very, very quickly just through deposit insurance. And then you have this longer term issue, which is about the assets that these banks hold, particularly the smaller, medium-sized ones in the US. And that is largely about commercial real estate. And again, none of this is surprising because, the IMF, which is never sort of head of the curve on this stuff, published this big financial stability report 2 years ago, looking at the commercial real estate globally and saying, this is the big risk from what's happening right now. And it's US small and medium-sized banks that are most exposed to this. So none of this is surprising. It's taking time for people to realize. And at the moment, I don't think that's the sort of dominant concern in markets. The dominant concern is just the liquidity risk.
Are you surprised how well the markets held up during this scenario?
No, because the a lot of the US market is just an interest rate play. So as the terminal interest rate has come down, all of the stuff that got absolutely hammered on the basis of higher interest rates, for the past 12 months is all retracing. So ironically, it's stuff like US tech that is coming back.
There you go.
And that, I think there's something about the psychology of stock investors there, because I remember at the start of COVID, I remember having, conversations with clients who just kept saying, just remember, the stock market is not the economy. And for large parts of the stock market, the only thing that matters is the discount rate. And that's basically the way we've traded for 3 years. The sort of value versus growth has just completely traded with interest rates. And so as, it's become clear that the Fed and these other central banks are going to have to at the least pause or perhaps cut interest rates, the terminal interest rate has collapsed and all of this stuff has reflated again.
Okay, let's make a headline. What does the Fed do tomorrow?
Well, I mean, it looks like they're going to do 25 because they want to make a point. It's almost
they don't want to show panic, do they? Doing nothing.
It's central bank of virtue signaling. That they're trying to show.
What do you call it? Central bank what?
Virtue signaling.
Virtue.
They're trying to prove that they're trying to prove that they still care about inflation, that they're still focused on the economy, that they're still there to sort of do their job for the public. But behind the scenes, they are bricking it about what's happening in the banking sector because that is their constituency. They deal more closely with the banks than anything else. So I think that they will try to make that separation between financial stability and price stability. It's completely fake and artificial, but that's where we are. They'll do one more token interest rate hike, for the sake of signaling that virtue, and then they're done. And then they'll be trying to, they'll be hoping that these issues in the banking sector start to ease. They'll be hoping that this doesn't lead to this big credit crunch for small and medium-sized enterprises. And if they're wrong on that, and that stuff does start to, become a more serious problem, then they'll be cutting interest rates.
And they're also going to hope that crude stays down here and doesn't rally to 100, because that would bring back inflation issues big time. I'm still paying
Yeah, I mean,
$5
at the
a gallon.
moment,
Yeah,
at the moment, we haven't seen the sort of big reopening in China effect on commodity
right.
prices. You know, I think that a lot of that is sort of backlogs. So, you know, if you look at Chinese people booking flights internationally, it's sort of gone through the roof. So that's coming, you know, that sort of travel and, you know, particularly air travel and sort of Chinese demand is coming, but it's just taking longer than people thought, because we thought we'd just be seeing Chinese people everywhere, you know, as soon as they reopen. But
Right.
you know, a lot of people have had their visas sort of expired over the last 3 years. It's going to take time for them to, you know, get on those flights and for that to start to affect commodities in the way that people were expecting. And so, you know, that could come later. But at the moment, that's not the focus, I think, for central banks.
Okay, well, everybody, Dario Perkins, in the middle of a banking crisis where people are freaking out, with his calm demeanor, has told us that really not a lot to worry about banking wise, and that the artificial economy is just going to have to make adjustments to the malinvestment. Is that the takeaway, Dario?
Yeah, I mean, you know, we could be in for a sort of tricky few weeks. I think that, you know, central banks are still sort of fighting the fire here. But I think when you look at what's happening in global banking, I mean, this is just so different from 2008. You know, you just don't have that sort of systemic risk that was there before. You have a risk of deposit flight in smaller banks, but that should be pretty easy to fix. And I think, you know, the really important thing here is that central banks went through this in 2008 and they do not want to go through it before. So whatever they have to do to backstop the banking system, they will do that. And if that means higher inflation for the next sort of 6-12 months, they take that, because it's the better of two evils. You know, the inflation problem is there, but it can wait.
Yeah, inflation's like cancer, and we just had a heart attack. So you treat the heart attack.
I think that's where the focus will be, for sure.
Do you like that medical metaphor?
Yeah.
It'll work for you. You can use
Yeah,
it.
no, I think it's right. I think that's the way that they'll be thinking about it.
Anyway, I'm getting palpitations now, so we better wrap. we better wrap it, bro, before I'm face down on my keyboard. Just kidding, Dario. Really love talking to you, and you really you calm me down. I think anyone that hears your voice, you'd be an excellent central banker.
Is that an insult or?
Huh? What's that?
I take that as an insult. I'd be an excellent central banker.
Well, you can, but I mean, you know, you would calm down the public anyway. So,
I know, I'm joking.
And I really appreciate you, you know, giving us your time and coming here every 3 months or so, and dropping a dose of sanity on us in a crazy world. Thank you.
It's always a pleasure.
Dario Perkins, everyone. You want people to follow you, right? At Dario Perkins on Twitter?
Yeah, please do. That would be good.
Anywhere else?
No, that's the best place to start. So, you know, I tweet a lot. I post lots of sort of charts and links to analysis. So that's a good place to start.
Okay. Thank you, Dario, very much. Appreciate your time.
All right. Take care.
I'll talk to you in the summer. So Dario Perkins, everyone, at Dario Perkins. And thank you for your attention, everyone. Get ready for the Fed. Know your levels. React to the reaction. And you could join the team in 17 minutes on the Morning Edge. Most of all, everyone, just, you know, realize how fortunate you are to be a speculator and not have to worry about, you know, can you pay your rent this month? Keep your perspective and don't just count your pips, count your blessings. Adios. Thank you, everyone. Oh, you're welcome. You're welcome. And you're welcome. Thanks, Dario.